Let's just jump right in. You can definitely feel a chill in the air again, can't you? After that period near the end of last year, it felt pretty exciting, almost warm, But then early 2025, we saw some pretty significant dips in the crypto market.
Yeah, it felt quite sudden for a lot of people, I think. Hit quite hard.
Exactly.
Yeah.
And well, suddenly everyone's asking that same question again. Are we staring down another proper crypto winter? Or is this just, I don't know, the deep freeze lingering longer than we thought?
It's absolutely the main question right now, driving conversations everywhere, investors, market watchers. And honestly, when you look at the Q1 data for 2025, it definitely makes you pause, especially if you look beyond Bitcoin itself.
Right. And that's exactly what we're doing today, a deep dive into that very question. We're going to start by revisiting what a crypto winter even is. What did we actually learn from the last one? What lessons really stuck?
Yeah, what did the industry really internalize?
Exactly. Then we'll dig into the recent data, Q1 2025, see what that tells us about where the market's temperature is now. And really crucially, for you listening, especially if you're investing here in the U.S., what does the landscape actually look like for you right now?
And to do that, we've gathered insights from, well, quite a few recent reports and analyses. We've tried to get a broad view, looking at sources like Built-in, Galaxy, Forbes, The Cryptonomist, Cambridge Associates, Vera Times, 21 Shares, CoinShares, quite a range. The idea is to piece together the clearest picture we can from all these different angles.
Yeah, our mission here is pretty straightforward.
Yeah.
Hope you cut through the noise. There's just so much chatter, so many headlines flying around.
Always.
We want to help you get a handle on the key dynamics, really driving things, pinpoint the lessons from past cycles that are actually useful, and figure out what the latest shifts, especially around big institutions getting involved and U.S. regulation, what that might mean for where we're headed. Ultimately, we want you to come away from this feeling, more informed, more confident navigating this. Well, let's face it, volatile space.
Definitely volatile.
Oh.
So where should we start? Maybe define what we're even talking about with a crypto winter.
Good idea. Let's pin that down first.
Okay, so it's not just, a bad week or a bad month. It's basically a really prolonged bear market. We're talking significant, sustained price shifts across the board for most cryptocurrencies.
Like serious drops.
Oh, yeah. Assets losing 70%, 80%, sometimes even 90% or more from their peak value. It's brutal. And it's not just prices. You see trading volumes just plummet. Activity really slows down.
Everything just freezes up.
Exactly. And maybe the most obvious thing is the mood. The investor sentiment just gets really low, really pessimistic. It turns into this kind of waiting game, when will things turn around?
And these winters, they don't just happen out of nowhere, right?
Yeah.
There are usually specific triggers behind them.
That's right. They don't happen in a vacuum. The triggers can vary quite a bit. Sometimes they're really tied to bigger economic downturns. If the global economy gets shaky, riskier assets like crypto often take a much harder hit.
Makes sense.
Regulatory uncertainty is a huge one, too. If people are scared or confused about how governments might crack down or regulate crypto, that can really spook investors and companies.
Yeah, nobody likes uncertainty.
Nobody.
Yeah.
And sometimes it's simpler. It's just a loss of confidence. Maybe a big project fails spectacularly, or turns out to be a fraud, or maybe people just lose faith for a while in the immediate promise of the technology itself.
Okay, so let's talk about the last big one, roughly 2022 into 2023. That one felt particularly nasty.
It was incredibly harsh. The total crypto market cap dropped by something like 70% just in 2022 alone.
Wow, 70%.
Yeah. And just for context, that's roughly the same scale as the drop back in 2018 after that whole ICO bubble burst. But what made the 2022-2023 winter feel different, maybe more systemic, was that it wasn't just one thing popping. It was like a whole series of interconnected failures within the crypto industry itself.
Ah, right. The domino effect everyone was talking about.
Precisely. It really felt like this catastrophic chain reaction. You had the Terra Luna algorithmic stablecoin just collapsed.
That was huge.
Huge shockwaves from that, which then put massive stress on major crypto funds like Three Arrows Capital. And that had knock-on effects for lending platforms like Voyager Digital and Celsius.
Which then went bankrupt.
Exactly, leading to bankruptcies. And then, of course, the really big ones that grabbed all the headlines, the implosion of the FTX exchange and its sister company Alameda Research.
Can't forget FTX.
No. And then BlockFi followed soon after. The sheer number of these failures, how big they were and how interconnected they all turned out to be, That's what really defined this last winter. It wasn't just sentiment getting hit, it fundamentally shattered trust and just hammered prices across the board.
And like you said earlier, it wasn't just the crypto industry's internal problems causing this.
No, absolutely not. These implosions were happening at the same time as major macroeconomic headwinds were picking up steam. You had central banks worldwide, especially the US Fed, getting really aggressive with raising interest rates to fight inflation.
Right, money got expensive fast.
It did. Borrowing costs went up. Global liquidity just tightened significantly. The US dollar got stronger too, which makes other assets less attractive. Basically, this whole environment made investors pull back from risk assets everywhere. Crypto got hit hard, but so did, high tech stocks, fintech. It was a broad pullback from risk, a really potent combination.
Okay, that sets the scene for the last big freeze really well. So let's fast forward now to what's been happening more recently, specifically Q1 2025, which is what's got people asking if winter's knocking again. The data, especially from sources like the Cryptonomist, drawing on Coinbase and Glassnode, it really shows a dramatic turn, doesn't it?
Oh, it absolutely does. That report pointed to a really sharp reversal after what they called an explosive December 2024, where the total crypto market cap, if you exclude Bitcoin, hit a peak around $1.6 trillion.
Okay.
The first quarter of 2025 saw a really swift and pretty significant pullback. The market cap just for altcoins crashed by 41%.
41%.
In just 3 months.
In just 3 months, bringing that value down to about $950 billion. I mean, that's a huge chunk of value just evaporating from the broader crypto market outside of Bitcoin in a very short time.
Wow. And what about the funding side? Venture capital, did that hold up? Well, that's where it gets a bit tricky. VC flows also showed signs of, let's say, contraction. The Cryptonomist report noted something interesting. The headline number for total VC investment in Q1 2025 actually looked like the highest since Q3 2022.
Okay, so that sounds positive.
But, and this is a big but, that number was massively, massively skewed by one enormous deal. A $2 billion strategic investment from MGX, a sovereign-linked fund in the UAE, into Binance.
Ah, so take that one huge deal out, and the picture changes.
Completely. If you remove that single outlier, the actual amount of VC money going into crypto startups in Q1 2025 would have been lower than the previous quarter, Q4 2024.
Okay, that's a very different story.
It puts the trend much closer to those 4-year lows we saw around 2017, 2018. And what that suggests is that those big macro worries, the fear of a global recession, trade tensions, central banks keeping money tight, they're still casting a really long shadow. The allocators, the people managing the big pools of capital, they're just being much more cautious, much more selective about where they put their money in the crypto space right now.
So yeah, definitely mixed signals then. Altcoins took a big hit, VC funding looks weak beneath the surface of that one big deal, and the macro anxieties are still there.
Exactly. While some reports might mention sentiment improving based on certain metrics, the actual price action in Q1 for many assets was undeniably chilly. Let's look at some specifics from that Cryptonomist report, Bitcoin and Ethereum. Bitcoin, usually seen as the benchmark, it showed some relative strength compared to altcoins, but still, its price dipped below $90,000 at one point in the quarter.
Okay.
And maybe more telling, from a market health view, the data showed over 4 million Bitcoin were actually being held at a loss, meaning their current price was lower than the price when they last moved. That's a huge jump from the start of the year when fewer than 500,000 were in that position.
But didn't Bitcoin's dominance go up during this time?
It did, yes. Its dominance, its share of the total crypto market cap climbed to 63%. That's the highest it's been since 2021.
And what does that usually mean?
Well, it's often seen as a flight to perceived safety within crypto itself. When investors get nervous about the wider market or specific altcoins seem too risky, they tend to pull back into Bitcoin, which is viewed as, less speculative, more established, sort of the digital gold idea playing out.
Okay. And what about Ethereum, the number 2 crypto? The data suggests its situation in Q1 was maybe a bit more shaky.
The data presented for Ethereum definitely paints a more concerning picture for that specific quarter. Its price dropped quite significantly, 45%.
45%, wow.
Yeah, and its liquid supply increased by 15%. Now, liquid supply basically means ether that isn't locked up in staking or DeFi protocols. It's readily available to be sold.
So more potential selling pressure.
That's typically how it's interpreted, yes. More ether hitting the open market, potentially pushing prices down.
And the fees on the Ethereum network, they dropped a lot too, right? Even though people were still using it.
They did, yeah. Transaction fees collapsed by 54%, even though the actual number of transactions stayed pretty stable.
How does that happen?
It's likely a combination of things. Probably less overall demand for that prime real estate, the block space on the main Ethereum chain compared to peak hype times, but also significantly the impact of recent network upgrades, like the Denkan upgrade.
Ah, the one that made layer 2s cheaper.
Exactly. Denkan drastically cut transaction costs on those layer 2 scaling solutions built on top of Ethereum. If it's way cheaper to transact on an L2, there's less need to pay high fees on the main layer 1 chain. So demand for L1 block space falls, pushing down those fees.
Okay, got it.
So you have this collapse in fees combined with the 45% price drop and that increased liquid supply. It all contributed to a situation where the report mentioned over 40 million ETH were effectively in perdita, held at a loss compared to their acquisition price. It just shows the specific headwinds Ether faced in Q1.
The report also mentioned the new ETFs, the spot Bitcoin ETFs in the U.S., and market correlations. What was the takeaway there?
Right. The U.S. spot Bitcoin ETFs, they definitely saw positive inflows when they launched and early in 2025, but that initial momentum really seemed to slow down quite a bit as the quarter went on.
Okay.
Spot Ethereum ETFs, well, they were talked about, but there wasn't really a clear, consistent trend in performance noted for them yet. And regarding correlations, the report found that while crypto's correlation with U.S. stocks did tick up a bit recently, if you compared it to traditional safe havens like gold or bonds or even major fiat currencies, crypto generally maintained a low or even negative correlation.
And so still acting somewhat independently.
It suggests that maybe in times of really high stress or specific market shocks, Bitcoin and Ethereum might still behave more like unique, uncorrelated assets rather than just mirroring whatever traditional markets are doing. Volatility was definitely high, but maybe not at historical extremes, although some assets like Solana did show much bigger price swings.
Okay, so Q1 2025 definitely felt like a significant cooling off, maybe even a return to chilly conditions for a lot of the market, particularly outside Bitcoin. But thinking back to that really tough winter, 2022-2023, what did we actually learn from that? What were the big takeaways for people trying to build something real in this space? And for investors, too. I know Bobby Zagata wrote a piece for Built In that outlined some really key lessons.
Yeah, he framed that whole period not just as a downturn, but as a really, really crucial learning phase for the entire industry. And one of the biggest lessons he hammered home was the absolute primacy of fundamentals.
Okay, primacy of fundamentals. In the crypto world, what does that actually translate to? What does that mean on the ground?
It means having a relentless focus on really two things: product excellence and regulatory compliance.
Okay.
He made the point that during the crazy bull markets, companies get flush with cash, they get caught up in all the hype, and they can forget the basics. They chase growth at any cost instead of building a really solid foundation.
Right, it happens all the time.
So the core lesson is, if you want to survive and actually thrive long-term, you have to double down on building products and services that are genuinely useful, that solve real problems or meet real needs for customers in this evolving Web3 world. It's not just about flashy tech. It's about reliability, usefulness, setting new standards.
And the second part, compliance.
Yeah.
He called that table stakes.
Exactly that phrase, table stakes, meaning it's the absolute minimum requirement now, non-negotiable. You have to operate with the proper licenses. You need to adhere to the regulatory standards as they evolve. And you need to be incredibly clear and transparent with your users about how you're doing that.
Building trust seems key.
He argues it's the most important thing. Building that trust with your users is fundamental for credibility, for longevity in this ecosystem. It's really the only way, he suggests, that the industry can avoid repeating those catastrophic failures we saw last time, that whole domino effect.
Yeah.
Because cutting corners on compliance, on security, it always comes back to bite you. And it doesn't just hurt your company, it damages the entire space.
That really makes sense. When things are booming, the temptation is always move fast, break things. But maybe the lesson is move carefully. Build things right. Okay, what was the second big lesson he pulled from the winter?
The second one is all about the power of education and pairing that with a genuine long-term vision.
Education. How so?
Well, the article makes a really interesting contrast. With many Web 2.0 companies, right, the more you learn about their business models, maybe their data privacy practices, the less you might actually want to use them.
Good point.
But in Web 3 and crypto, he argues, the opposite can often be true. The more people actually learn about the underlying blockchain technology, what it can do, how it works, the more interested they often become, the more they want to engage.
That is a different dynamic.
It really is. So investing time and resources into educating your customers, educating the wider community. It's not just a nice to have, it's actually key to onboarding the next wave of users and making sure the growth is sustainable, not just built on hype.
And what kind of education are we talking about?
It needs to be pretty comprehensive, teaching people how to get started safely, how to onboard into the ecosystem securely, helping them understand how to make informed investment decisions, and crucially, understanding the risks involved.
Very important.
Absolutely. Teaching them how to protect their digital assets from all the scams and hacks out there. And maybe most importantly, helping them grasp the huge range of potential uses for blockchain beyond just speculating on price.
Right, because it's not supposed to be just about trading charts all day.
Definitely not. The article specifically mentions things like blockchain in gaming, developing digital identity solutions, using on-chain governance for decentralized organizations, things like staking. These show the broader potential. Digital assets like Bitcoin or Ether, they're just the starting point. The real long-term opportunity is in the applications built using the technology. And that ties directly into needing that long-term vision, which was also mentioned in the VI Times piece. You have to remember, this market is still incredibly early. It's nascent. Keeping that long-term perspective, focusing on the potential over years, even decades, helps you ride out those inevitable short-term storms, those price swings that feel so dramatic when you're in them.
Makes sense. Okay, lesson 3 seemed focused more internally on how companies actually build their teams during these cycles.
Yes, and this comes straight from watching what happened during the last bull run, those hiring frenzies. You had companies suddenly flush with cash, either from token prices soaring or massive VC rounds.
Right.
And they just started hiring like crazy, often making really short-sighted decisions, maybe hiring too fast, just trying to keep up with competitors or perceived growth needs.
And then the music stopped, and we saw mass layoffs across the industry.
Exactly. The article really emphasizes the huge cost of those kinds of dramatic, sudden cuts. It's not just the operational disruption or the terrible impact on morale for the people left behind.
Yeah.
It's about profoundly disrupting people's lives. And you lose so much valuable talent, so much passion, so much institutional knowledge just walks out the door.
Yeah, real brain drain.
It can be. So the hard lesson learned is, even when times are good, maybe especially when times are good, you need to focus on building a strong, resilient team. Foster a company culture that's built on a shared purpose, on sustainable principles. Scale in a way you can actually maintain, even through a downturn. Build for the long winter, not just the peak summer.
Right. Build sustainably. Okay, so those are crucial lessons for the companies in this space. Fundamentals, education, long-term vision, sustainable teams. But what about for the individual investor listening right now, trying to navigate these choppy waters? The VI Times article also offered some practical strategies, right? Survival tips.
It did, yeah. It laid out several really valuable approaches that can help take some of the emotional stress out of dealing with volatile markets. The first one is probably the most well-known, dollar cost averaging, or DCA.
Okay, explain DCA quickly.
Sure. It's simple, really. You commit to investing a fixed amount of money, say $100 or whatever amount works for you, into a specific cryptocurrency at regular intervals, maybe every week, maybe every month. And you do it regardless of what the price is doing that day.
So it stops you from trying to perfectly time the market lows and highs.
Exactly. Which is almost impossible to do consistently anyway. With DCA, you're averaging out your purchase price over time. When the price is high, your fixed $100 buys less crypto. When the price drops, that same $100 buys more. Over the long run, this strategy can lower your average cost per coin and smooth out the bumps from price volatility.
Okay, that makes sense. What's number 2?
Diversification.
Yeah.
You hear it constantly investing, but it's especially critical in crypto. Don't put all your eggs in one basket. Don't pour all your capital into just one coin, or even just 2 or 3.
Spread the risk.
Spread the risk. Across different types of cryptocurrencies, different blockchain projects may be focused on different things, even different sectors within crypto like DeFi, NFTs, maybe infrastructure plays, gaming tokens. By diversifying, you cushion the blow if one particular coin or sector has a really bad run.
Okay. Third strategy.
Standard risk management, but tailored for crypto's unique volatility. This means using tools that are available on most exchanges, like stop-loss orders.
How do those work?
A stop-loss automatically triggers a sell order if an asset's price drops to a level you've predetermined. It helps you limit your potential downside, your losses, if the market suddenly turns against you. Risk management also means having a plan for taking profits.
Ah, the hard part for many people, selling when things are going up.
It can be,
Yeah.
but it's crucial. Decide in advance at what price points you might want to sell a portion of your holdings to lock in some gains and reduce your overall exposure, especially after a big run-up. Don't just ride it all the way up and then all the way back down again.
Good advice. Okay, strategy number 4. We touched on it, but it's worth repeating.
Absolutely. Maintaining that long-term perspective. It is so easy to get consumed by the daily, even hourly price swings, especially when the market is wild. But you have to consciously remind yourself this is still a very young market. Focus on the fundamental potential of the technology over years, not just weeks or months. Having that longer time frame helps you filter out the short-term noise and hopefully stick to your original investment plan without panic selling.
Okay. And number 5 involved finding other ways to earn within crypto.
Yes, exploring alternative income streams that the crypto ecosystem offers beyond just hoping the price goes up. The article mentioned things like staking.
Explain staking briefly.
Sure. With certain cryptocurrencies, proof of stake ones,
Yeah.
you can stake or lock up your coins to help secure the network and validate transactions. In return for doing that, you earn rewards, usually paid out in more of that same coin.
Yeah.
There's also lending your crypto assets through various DeFi protocols to earn interest, or participating in yield farming, which is a bit more complex, but involves providing liquidity to DeFi platforms to earn fees and token rewards. These kinds of activities can potentially generate passive income on the crypto you already hold.
So you could still be earning something even if prices are flat or down.
Potentially, yes. It can be a way to accumulate more assets or generate some cash flow during those colder market periods when just holding for price appreciation isn't working as well.
Okay. And the final tip was about community.
Yeah, community engagement. Let's face it, navigating the crypto world can feel complex, sometimes even isolating if you try to do it all on your own. Staying informed by following reliable news sources, joining discussion groups or online communities, connecting with other people who are also learning and investing, it can provide really valuable insights. You might learn about new projects, get different perspectives, avoid scams, and honestly, just get some emotional support during the tough times.
That's a great point. Don't go it alone. Okay, so we've got the hard-won lessons from the last winter. We've got some practical strategies for investors. Now let's really zoom in on the present day, and let's specifically at the U.S. The big question, is the winter over, at least for U.S. investors? Or are we maybe just in a temporary thaw? We know sources from early 2024 were already pointing to some hopeful signs, market dynamics looking a bit better, maybe some progress on regulation, and of course the huge deal, the approver of those spot Bitcoin ETFs.
And focusing right there on the U.S. landscape, the data coming out about institutional adoption through those very ETFs is really, really compelling, especially looking at the CoinShares Q4 2024 data. It gives us a fantastic snapshot of what the big regulated money is actually doing.
Okay, so what does that data show? Are the institutions really jumping in?
It shows pretty significant and, importantly, accelerating growth in institutional ownership of these U.S. Bitcoin ETFs. Get this. By the end of Q4 2024, professional investors, and we're talking the big players here, institutions managing over $100 million, the ones who have to file those public 13F reports.
Okay, the serious money.
The serious money. They held $27.4 billion worth of U.S. Bitcoin ETFs. Now compare that. Just the previous quarter, Q3 2024, they held $12.4 billion.
So it more than doubled in one quarter.
It increased by 114%. Massive jump. And interestingly, their holdings grew faster than the overall U.S. Bitcoin ETF market itself, which grew 77% in the same period to hit $104.1 billion in total assets under management, AUM.
So institutions are grabbing a bigger slice of that growing pie.
Exactly. As of the end of Q4, these professional investors represented 26.3% of all the assets in U.S. Bitcoin ETFs. That's up noticeably from 21.1% just 3 months earlier. It's a very clear trend. Large, regulated players are entering this market.
Okay, and which types of institutions are leading this influx? Is it pension funds, endowments?
The CoinShares report breaks it down. Right now, it's primarily hedge funds and asset managers leading the charge. What's really notable is that hedge funds, just by themselves, now account for 41% of all the Bitcoin ETF holdings reported in those 13F filings, measured by dollar value.
41% just from hedge funds.
Yep. And that's the first time hedge funds have actually surpassed investment advisors in terms of the total dollar amount held, according to these public filings.
That's interesting. Hedge funds are usually seen as quicker movers, maybe more willing to adopt new things.
That's generally true. And the data shows the money is quite concentrated in a few big names. Millennium Management was the largest single holder disclosed,
Yeah.
with a massive $2.6 billion position spread across 6 different spot Bitcoin ETF products.
$2.6 billion.
Yeah. Brevin Howard holds a significant $1.4 billion, and they've been openly bullish on Bitcoin. It was reportedly their second largest position, making up 8.7% of their firm's total AUM. D.E. Shaw & Co., another major quantitative firm, held $873 million. So big commitments from major players.
And are they all piling into the same ETFs? Or is it spread out?
Well, the top products held by institutions capture most of the market, 86% of the total U.S. Bitcoin ETF AUM at year-end. BlackRock's IBIT, the iShares Bitcoin Trust, was the leader in attracting institutional dollars, holding $16.3 billion from these filers, which is about 31.5% of IBIT's total assets. And institutional ownership in IBIT grew incredibly fast, 196% just in that quarter.
Huge growth.
Huge. Fidelity's FBTC also saw strong adoption, holding $4.4 billion from institutions, 25.5% of its AUM, growing 72% quarter over quarter. Even GBTC, the grayscale Bitcoin Trust, which existed before the spot ETFs and saw some outflows overall, even its institutional ownership actually increased by 43% in the quarter, holding $3.4 billion, though that's a smaller percentage of its much larger total AUM.
Okay, so hedge funds leading in dollar terms. What about the investment advisors? You said they were surpassed in dollar value, but are they still active?
Oh, very active. Investment advisors are nearly equal in dollar terms, also representing about 41% of the 13th holdings by value. But that capital is spread across a much, much broader base. Over 1,200 different investment advisory firms reported having some allocation.
Wow, 1,200 firms.
Yeah, so wider adoption, perhaps smaller average allocations per firm compared to the big hedge funds. Examples mentioned included big names like Goldman Sachs holding $1.6 billion and Horizon Kinetics with $1.2 billion. And you also have brokerages playing a key role, like Jane Street, $1.7 billion, and DRW Securities, $365 million, providing that crucial liquidity and market making for these new ETF products.
And the CoinShares data had something even more groundbreaking, didn't it? About a sovereign entity.
Yes, this was a really significant milestone highlighted in the report. The Emirate of Abu Dhabi filed a 13F disclosing a $439 million position in U.S. Bitcoin ETFs in Q4 2024.
A sovereign wealth fund, basically.
Effectively, yes. This is the very first time we've seen sovereign exposure to Bitcoin publicly disclosed through these mandatory U.S. institutional filings. It's seen by many in the space as really symbolic, emblematic of Bitcoin potentially gaining acceptance not just with corporations or funds, but on the global stage, maybe even as a potential reserve asset down the line.
Okay, so if you had to summarize all that institutional data, the takeaway is pretty clear.
Absolutely. The CoinShares report puts it bluntly. This data underscores the accelerating institutionalization of Bitcoin ownership, at least via these U.S. vehicles. Professional investors now hold over a quarter of the U.S. market, which translates to about 1.5% of the total outstanding Bitcoin supply globally.
Still relatively small overall, but growing fast.
Yeah. Exactly. The report's perspective is that these initial filings are really just the beginning of mainstream adoption. The average allocation size among these institutions is still less than 1% of their portfolio, so there's theoretically a lot of room for growth if they decide to increase those positions. And, most Bitcoin is still held by retail investors, smaller firms not required to file 13Fs, and those quick-moving hedge funds. But the direction of travel seems undeniable. The doors are opening wider for large, regulated, cautious capital to come into Bitcoin through these familiar ETF structures.
Okay, that's a huge shift in market structure. Now let's pivot to the rules governing that market. The U.S. regulatory environment has always been this big, looming question mark. Forbes reported recently on some potentially significant changes happening at the SEC, the main securities regulator.
Yeah, that article suggests we might be seeing, let's say, shifting winds. There's new leadership with Chairman Paul Atkins and Commissioner Hester Pierce, who many know as Cryptomom for her generally pro-innovation stance, seems likely to have an expanded role. The feeling is the agency might be moving towards a more structured, maybe more innovation-friendly approach. That's after years of what many in the crypto industry felt was basically regulation by enforcement.
Meaning they sued first and defined the rules later.
That was a criticism, yes. That the rules were often unclear until enforcement action was brought against someone. Now there seems to be an effort towards providing more clarity up front.
And have they actually provided any specific clarity yet? That's been the big ask for years.
Well, yes, and this is key. There have been some important staff-level statements recently. One offered guidance on how meme coins might be viewed under securities law, which is suddenly very relevant given some recent political happenings we should touch on. Another statement clarified the SEC's thinking around stablecoins, specifically when they might cross the line into being regulated as securities.
Okay, staff level, so not official rules yet.
Not formal binding rules, no. But they represent a potentially significant shift in tone and approach. It signals an attempt to offer more predictability, which the industry has craved, instead of that constant ambiguity and retroactive rulemaking through enforcement.
And the new chairman, Atkins, seems to be championing this shift.
He does, very publicly. He's been quite vocal about needing to create clear rules of the road for the crypto markets. He even argued at a roundtable back in April that innovation in the U.S. had been actively stifled by the previous ambiguous and enforcement-heavy approach. His stated goal is to shift the SEC towards creating coherent, forward-looking policies that actually encourage compliance. That's a very different message than the industry was hearing previously.
That sounds like exactly what legitimate crypto businesses in the U.S. have been asking for.
It really does. And there's definitely hope that this could foster the growth of compliant, properly run firms here. The ideal scenario is a robust U.S. regulatory framework that effectively weeds out the bad actors engaging in illegal activities, which is crucial for market confidence, but also allows legitimate, compliant businesses to grow and innovate. The Galaxy report we looked at went even further.
What did they suggest?
They argued that the current U.S. administration and Congress might actually be putting in place what could be seen as the most pro-crypto policies in U.S. history. Their view is that this could really cement U.S. dominance in the global crypto sector, especially if key pieces of legislation like frameworks for stablecoins and overall market structure get finalized. That would provide the clarity needed for traditional big finance firms to really enter the space confidently.
Okay, that sounds very positive.
Okay.
The Forbes article also highlighted some major political complications bubbling up right now that could throw a wrench in the works.
Ah, yes. This is where it gets particularly messy and very political. The article dives into Eric Trump's recent involvement with the Trump meme coin. Apparently, this token is linked to some contest offering dinner with the former president.
A meme coin linked to a presidential candidate.
Linked to the former president, yes. And Eric Trump is also reportedly set to appear at a conference alongside Justin Sun.
Justin Sun, founder of Tron. He's a controversial figure.
Very controversial, and reportedly a very large holder of this Trump meme token himself. So you have this convergence of meme coins, political figures, and controversial crypto personalities.
I can imagine that raised some eyebrows in Washington.
Immediately. Prominent Democrats, including Senators Elizabeth Warren and Adam Schiff, and Representative Maxine Waters, voiced serious concerns very quickly. They've publicly called for ethics investigations into this Trump meme coin situation.
What are their specific concerns?
They're worried about potential conflicts of interest, obviously, concerns about foreign influence, given someone like Justin Sun's involvement. And critically, the possibility that these kinds of ventures could be used as a way to funnel money, perhaps anonymously, to the former president or his campaign or inner circle. Waters and Warren were particularly direct, specifically calling on the SEC to investigate these Trump family-linked crypto activities.
Okay, so just as the new SEC chair is trying to project stability and clarity, they get this political hot potato dropped in their lap.
Exactly. Forbes really frames this as a major early test for Chairman Atkins and the SEC's new direction. He's trying to implement regulatory reform and build trust through predictability, but now he has to navigate this highly politicized situation involving the family of a former president and current candidate. He needs to demonstrate unwavering commitment to impartial enforcement, regardless of who is involved.
Yeah, any perception of political favoritism could be damaging.
Hugely damaging. Whether it's real or perceived under this kind of intense scrutiny, it could seriously undermine the agency's credibility and hurt its efforts to build trust, even if they are making genuine progress on providing regulatory clarity elsewhere. It's a really, really tricky tightrope for the agency to walk right now.
Definitely a complex situation. But it's worth remembering, as the Galaxy report noted, even with this sometimes confusing or frustrating regulatory backdrop, the U.S. still dominates the global crypto startup scene, right? In terms of deals and funding.
That's a crucial point, yes. Despite all the challenges, the U.S. remains the center of gravity for crypto innovation and investment globally, both by the sheer number of startup deals and the total amount of capital being invested here.
Okay, so we've revisited the last winter, we've pulled out those key lessons, we've analyzed the current U.S. picture,
Yeah.
the institutional money coming in via ETFs, the evolving but politically complicated regulatory scene.
Yeah.
Where does this leave us looking ahead? Given all the volatility, the past struggles, does the long-term outlook for crypto still seem positive?
Based on the sources we looked at, including perspectives from places like Cambridge Associates and 21 Shares, the consensus seems to be yes. The overall long-term outlook for the crypto ecosystem is still viewed as fundamentally positive. And that's even factoring in the recent volatility and the really hard lessons from the last couple of years.
What's driving that continued optimism? Where's the positive momentum coming from?
Well, there are several factors. First, even though VC investment is way down from the absolute peak frenzy, and remember Q1 2025's headline number was skewed by that one huge deal, there's still activity. Q1 without the Binance deal actually saw an increase in the number of deals quarter over quarter.
Okay, so still some early stage stuff happening.
Some underlying activity, yes. And don't forget, 2022, despite being the start of the winter, was actually an all-time high year for total VC funding raised by crypto funds. A lot of that capital is still being deployed now.
Ah, dry powder.
Exactly. That continued investment, even if the pace has slowed, is funding crucial infrastructure development. It's allowing projects to hire talent to build out their products. All things that are expected to drive the next wave of user adoption and innovation down the road.
And are users still coming into this space globally? Or did the winter scare everyone away?
Actually, no. Despite the price crashes, the total number of global crypto users continued to grow significantly right through the last winter. And there's still this huge untapped potential in reaching new demographics, new regions around the world where adoption is still very low.
You mentioned earlier that a lot of important development happens under the radar during bear markets. Is that still the case?
Absolutely. That's a really key dynamic. When the speculative frenzy dies down, the builders often get their heads down and focus on the core technology. We're seeing continued progress in DeFi, for example. Grayscale noted rising fees on some protocols, which indicates actual usage. Those layer 2 scaling solutions, especially on Ethereum, are seeing really robust transaction numbers. And crucially, those transaction fees are coming down thanks to upgrades like Denkun, making the tech more usable, more affordable for real-world applications.
Right.
You see the success of specific platforms, too, like Solana, which Multicoin Capital highlighted as generating more fee revenue in Q1 than all other major Layer 1 and Layer 2 blockchains combined. That shows innovation and adoption can still thrive. And maybe one of the biggest developments is the rise of stablecoins.
Yeah, they seem increasingly important.
Hugely. According to A16z's Crypto, stablecoins reached record transaction volumes recently. They're becoming really central players in bridging traditional finance and digital finance globally.
Okay. Are there any potential outside factors, maybe macroeconomic shifts, that could help things improve?
The Cryptonomist report mentioned a couple of possibilities. One big one could be if the U.S. Federal Reserve eventually stops its quantitative tightening, basically, stops shrinking its balance sheet. That would inject more liquidity back into the global financial system.
Which usually helps risk assets.
Generally, yes. Another potential catalyst could be fiscal stimulus packages from other major economies, maybe the EU or China, trying to boost their own growth. These kinds of broader economic tailwinds could definitely create a more favorable environment for assets like crypto.
Okay, so there's a case for long-term optimism, continued development. But let's be realistic. What are the remaining cold spots? What are the potential failure points or risks that could still cause big problems or another downturn?
Yeah, it's crucial to stay grounded. Cambridge Associates and others point out some persistent, quite serious challenges, particularly where the crypto world meets traditional finance and infrastructure.
Like what specifically?
Things like crypto companies still finding it really difficult to get basic banking services from U.S. commercial banks, finding reputable accounting firms willing to audit them, even getting reliable web hosting sometimes. And after all the failures and consolidation, there's actually a fairly limited number of large, globally dominant, trustworthy spot exchanges left standing.
So if one of those failed?
Exactly. The failure of one of the remaining key infrastructure providers, or even just if traditional service providers like banks or auditors decide en masse to pull back from servicing the crypto industry, that poses a really material risk to the whole ecosystem's ability to function smoothly.
And regulation, despite the positive talk, that's still a big risk factor hanging out there.
Absolutely. Talk is one thing, implementation is another. Even with the SEC communicating more clearly under Atkins, actually getting new frameworks and regulations finalized, implemented, and enforced could be complex. It could face political roadblocks, especially with the recent controversies we talked about. It's far from a done deal.
Makes sense.
And then there are the macro risks that just haven't gone away. Digital assets, for all the talk of diversification, are still largely treated as risk assets by the big institutional investors. So if global trade tensions flare up again, if there are new geopolitical shocks, or if we hit another major macroeconomic downturn, crypto prices and sentiment could easily take another significant hit.
And interestingly, could those very spot ETFs that signal institutional adoption, could they also pose a challenge in some ways?
That's a fascinating point raised in the Galaxy report. They floated the idea that the very success and ease of use of these spot ETPs might actually pull some institutional capital away from traditional venture capital investments into early-stage crypto startups.
How so?
Well, if a large institution can get easy, liquid exposure to Bitcoin or maybe eventually Ether just by buying an ETF share through their regular broker, they might feel less need to make riskier, much less liquid investments directly into private crypto companies through VC funds.
Right. Why bother with the hassle and lockup periods of VC if you can just buy the ETF?
Yeah.
Which could make fundraising even tougher for startups.
Precisely. The VC fundraising climate for crypto is already quite challenging. You've got the lingering effects of the 2022-2023 washout, ongoing macro pressures, and now increasingly intense competition from AI startups, which are sucking up a lot of the oxygen and capital from allocators right now. The Galaxy report also noted a trend they're seeing towards VC deals favoring later stage, more established crypto companies, maybe shifting away from the very early pre-seed and seed rounds. This might just be the market maturing, but it could also mean that the sort of golden era of easy money for brand new crypto ideas might be fading.
Okay, so let's try to pull this all together now. We've looked back at the really tough lessons from the last crypto winter, analyzed the recent Q1 chill, dug into the U.S. landscape with ETFs and regulation. Drawing on all these different perspectives, what's the overall picture that emerges?
I think the picture is one of a market that has definitely been through the ringer and hopefully learned some incredibly valuable, if painful, lessons about the absolute necessity of focusing on fundamentals, the real power of educating users properly, and the critical need for building businesses sustainably, not just chasing hype cycles.
And while we saw some signs in early 2025 pointing towards maybe a renewed chill, particularly if you look beyond Bitcoin.
Right, the broader altcoin market definitely felt that Q1 pullback.
The landscape, specifically for U.S. investors, is also undeniably shifting in some pretty significant ways. We've got clear evidence of accelerating institutional adoption coming through regulated channels like the spot ETFs.
The data there is quite compelling.
And although it's complex and definitely facing political tests, we are starting to see a clearer, maybe more predictable regulatory path beginning to emerge in the U.S. after years of waiting.
Yeah, the tone shift at the SEC is notable, even if the path forward is still uncertain.
We've also covered some of those strategies you can use as an investor to try and navigate this ongoing volatility thinking long-term, the importance of diversification, managing your risk, staying plugged in and informed. And for the projects actually building things in this space, the key lessons from the winter seem sharper and more relevant than ever.
They really do. I think the core takeaways for building resilience in this ecosystem boil down to those fundamentals. You have to build trust, and you do that through rigorous compliance and delivering genuinely excellent products. And you have to recognize that real, sustainable, long-term success comes from patiently educating users and growing carefully, not just riding the next speculative wave.
And for you, the listener, the investor trying to make sense of it all, wading into this still very dynamic market, having that long-term view, actively diversifying your assets, using smart risk management tools, and just committing to staying informed, those really are your best tools.
Absolutely. Maybe one final thought to leave you with, something to chew on after all this discussion. Consider this. We're seeing increasing amounts of large, traditionally cautious institutional capital, maybe even sovereign wealth funds starting to flow into crypto, but specifically through these regulated, familiar products like ETFs, especially here in the U.S. And at the same time, U.S. regulators are, at least seemingly, starting to show more willingness to lay down clearer rules of the road after such a long period of ambiguity. So the question is, Are we witnessing a fundamental transformation? Are we slowly moving towards a future where crypto is maybe less defined by those incredibly wild boom and bust cycles driven mainly by retail speculation, and more towards potentially steadier, more incremental growth, influenced more by the calculated decisions of large, sophisticated capital?
That's the optimistic view, perhaps. Or will the inherent volatility that seems baked into digital assets, combined with unpredictable political interference like we just discussed, and the constant background threat of global macro shocks, will those factors continue to define this market's wild swings for years to come, almost regardless of who's buying the ETFs? It feels like that's the core tension we're watching play out.
It's a fascinating tension, and it will likely shape where things go from here. But that wraps up our deep dive for today, looking at the recent crypto winter, the vital lessons learned, and the really complex, fast-evolving state of play right now, especially for investors here in the U.S.
Yeah.
We genuinely hope this analysis gives you a more solid footing for understanding this challenging but still incredibly interesting market.
Yeah, hope it was helpful. Thanks so much for joining us for this deep dive.